Did you know that more than 9 out of 10 day traders lose money in their first year? Think about that for a second. If trading was really as simple as buy low, sell high, why do so many people fail? Is it just bad luck? Or is the game built in a way that makes you the underdog from the very start? Behind every flashing chart and every trade you place, there's a hidden player pulling strings, the market maker. You don't see them, you don't hear them, but they're always there, ready to buy when you sell and sell when you buy. They're not gamblers like you. They're the house, and the house always has the edge. This isn't about wild conspiracies. It's about structure. The system is designed to keep market makers steady and most retail traders struggling. And today, we're going to break it all down. Welcome to Wealth Pal, a place where future exceptionally successful and wealthy individuals gain an unfair advantage. If you haven't yet, hit that subscribe button and turn on notifications so as to never miss out on a future life-changing video. Without further ado, let's get right into it. The role of market makers. To understand why most retail traders struggle, you first need to know who market makers are and what they actually do. Think of them as the quiet dealers at the casino table. They don't play the game like you do. They run the game. A market maker's job is simple on the surface. They provide liquidity. That means they're always ready to buy when someone wants to sell, and always ready to sell when someone wants to buy. Without them, the market would feel like an empty store. You'd walk in wanting to buy something, but no one would be there to sell it. But here's the catch. They don't do this out of kindness. They profit from the bid-ask spread. Imagine you want to buy a stock at $100. The market maker might sell it to you for $100.10. Then, if you turn around and sell it back, they'll only pay $99.90. That tiny gap, just a few cents, is their steady profit. Multiply that by millions of trades a day, and you see why they never lose. It doesn't stop there. Market makers also see the order flow. They know where the crowd is leaning. If thousands of traders are rushing to buy, the market maker knows before you do. That knowledge is power. So while retail traders are guessing, hoping, and reacting, market makers are calmly collecting their edge. They don't need to predict the future. They just need to stand in the middle, taking a slice of every transaction. In short, market makers aren't gamblers. They're the house. And like any casino, the house doesn't need to win every hand. It just needs to keep the game going. How market makers exploit retail traders. Now that you know what market makers do, let's talk about how they actually profit from you, the retail trader. This is where the game feels less like a fair match and more like a chessboard where you're always 3 moves behind. First, there's the bid-ask spread trap. Every time you buy, you're paying a little more than the true price. Every time you sell, you're getting a little less. It doesn't feel like much, just pennies, but those pennies add up. For the market maker, it's like collecting tolls on a busy highway. Then comes stop hunting. Imagine you set a stop loss to protect yourself. Market makers know where those stops are clustered. They can nudge the price just enough to trigger them, forcing you out of your trade. Then the price bounces back in the direction you want it. You're left frustrated while they pocket the difference. Next is order flow advantage. Market makers see the crowd's intentions before the crowd acts. If thousands of traders are leaning one way, they can position themselves on the other side, ready to profit when the herd stumbles. There's also latency arbitrage. Their systems are lightning fast. By the time your order hits, they've already reacted, taken the best price, and left you with the scraps. And finally, psychological warfare. Fake buy or sell walls appear on the order book, tricking you into thinking demand or supply is stronger than it really is. Then, just as you act, those walls vanish and you're caught on the wrong side. Each of these tactics isn't illegal. It's just the way the system works. But together, they create a battlefield where retail traders are always fighting uphill. Why most retail traders lose? So why do most retail traders lose? It's not only because market makers have the edge, it's also because of the way retail traders approach the game. The first big reason is overconfidence. Many new traders believe they can outsmart the market after a few lucky wins. They think they've cracked the code, but in reality, they've just been riding short-term luck. That confidence leads to bigger bets, riskier trades, and eventually bigger losses. Next is a lack of discipline. Trading isn't just about spotting opportunities, it's about sticking to rules. Professionals cut losses quickly and protect their capital. Retail traders, on the other hand, often hold onto losing trades, hoping they'll bounce back. Hope is not a strategy, and it usually ends in disaster. Another reason is misunderstanding how markets really work. Many retail traders think they're trading against other small traders like themselves. In truth, they're trading against professionals with faster systems, better data, and deeper pockets. It's like bringing a pocket knife to a gunfight. Then there's the illusion of easy money. Social media is full of flashy traders showing off luxury cars and big wins. What you don't see are the thousands of people quietly losing their savings. This creates a dangerous cycle. People chase quick profits, ignore risk, and fall into the same traps over and over again. Finally, retail traders often overtrade. They jump in and out of the market too often, paying spreads and fees that slowly eat away at their accounts. Market makers love this because every trade means more profit for them. In the end, most retail traders lose not because they're unintelligent, but because they're playing a game they don't fully understand, and they're playing it against opponents who already know the outcome. Let's step into the shoes of a retail trader. We'll call him Daniel. On his first day, Daniel is buzzing with excitement. He's watched countless YouTube videos, read a few blogs, and feels ready to conquer the market. He opens his trading app, buys a stock, and within minutes, it goes up. He sells for a small profit. His heart races. This is easy money. The next few days, Daniel strings together a couple more wins. Confidence grows. He starts trading more often, increasing his position sizes. But then the tide shifts. He buys at $100, only to watch the price dip to $99. His stop-loss triggers, kicking him out. Moments later, the stock bounces back to $101. He's furious. This happens again and again. Each time, he feels like the market is out to get him. What Daniel doesn't realize is that market makers thrive on this. They profit from the spread every time he trades. They know where his stop-loss sits, and they can push the price just enough to trigger it. While Daniel is bleeding small losses, they're stacking steady gains. Weeks pass. Daniel's account balance shrinks. He tries to chase losses, doubling down, but that only speeds up the decline. The excitement that once fueled him turns into stress and frustration. By the end of the month, Daniel is drained, financially and emotionally. He wonders how the market makers always seem to win while he loses. The truth? They don't need to beat him directly. They just need him to keep playing. Daniel's story isn't unique. It's the story of thousands of retail traders who enter the market with hope, only to leave with empty accounts, while the market makers keep collecting their edge. The harsh truth. Here's the part most traders don't want to hear. The market isn't rigged in the sense of a secret plot against you. It's simply structured in a way that makes the odds uneven. And unless you understand those rules, you're always going to be the one paying the price. Market makers aren't cartoon villains sitting in dark rooms, plotting your downfall. They're a necessary part of the system. Without them, you'd struggle to find someone to take the other side of your trade. They keep the market moving, they provide liquidity, and they make sure you can buy or sell whenever you want. But here's the catch. They don't do it for free. Think of it like a casino. The casino doesn't need to cheat. The rules of the game already give the house a small edge. Over time, that edge guarantees the casino wins, even if a few lucky gamblers walk out with money. The same is true in trading. Market makers don't need to beat you on every trade. They just need you to keep playing long enough for their edge to work. The harsh truth is this. Most retail traders lose not because they're stupid, but because they're playing a game designed for professionals. The tools, the speed, the data, all of it favors the market makers. And unless you step back and recognize that, you'll keep falling into the same traps. So no, the market isn't out to get you, but it is built in a way that ensures the house always wins. And if you want to survive, you need to stop thinking like a gambler and start thinking like someone who understands the rules of the game. What smart traders do differently? If the game is tilted, Does that mean retail traders are doomed? Not exactly. The truth is, smart traders don't try to beat market makers at their own game. Instead, they change the way they play. First, they trade less often. Every trade you make is another chance for spreads and fees to eat away at your account. Smart traders know this, so they wait for high-quality setups instead of chasing every flicker on the chart. They understand that patience is a weapon. Second, they avoid overleverage. Many beginners think borrowing money to trade bigger positions will multiply their profits. What it really does is multiply their losses. Professionals know that survival is more important than quick riches. They size their trades so that even a string of losses won't wipe them out. Third, they focus on swing trading or investing rather than scalping against algorithms. Scalping, jumping in and out of trades within seconds, puts you directly in the ring with machines that are faster and smarter. Instead, smart traders zoom out, looking at bigger trends that unfold over days or weeks. Fourth, they practice risk management. This means setting stop losses wisely, not clustering them where everyone else does. It means accepting small losses as part of the game, rather than letting one bad trade destroy an account. Finally, they learn to read market structure instead of chasing price. They study how markets move, where liquidity pools sit, and how big players position themselves. They stop reacting emotionally and start thinking strategically. In short, smart traders don't try to be the casino's luckiest customer. They step back, slow down, and play a different game. One where the odds, while never perfect, are at least survivable. So here's the bottom line. Most retail traders don't lose because they're foolish. They lose because they're playing the wrong game. The market is structured like a casino, and market makers are the house. They don't need to beat you trade by trade. They just need you to keep playing long enough for their edge to work. But you don't have to be the casino's customer forever. The smart move is to step back, slow down, and change the way you play. Trade less often. Manage your risk. Stop chasing quick wins and start thinking long-term. If you want to survive and maybe even thrive, you need to stop acting like a gambler and start acting like a strategist. Because in the end, the only way to win is to stop playing their game and start playing your own. Have you ever been exploited by the market makers? Share your experience in the comments below. And if you found this video insightful, hit like, subscribe, turn on notifications, and share this with someone who needs to see it. Until next time, thanks for watching and see you in the next video.